Test, test. Test, test. All right. Go ahead and give it about 5 minutes before we start here. I'm on a little early. Hopefully it kicks out a reminder to people that we are going to be streaming here. This should be a short and sweet webinar. I can read the chat. At least I can read the YouTube chat. I don't know what the Twitter chat looks like. Is it working live on Twitter? It is working live on Twitter. Imagine that. Not going to be able to see Twitter chat, though. So go ahead and start in about 5 minutes. I'm early, but hopefully it kicks out a notify me to the people that are subbed. Crazy moves today, right? At the end of this, we're going to go through trade ideas, about 3 of them that fit kind of the same description as Crowdstrike. So it should be fun. So you're going to walk away, hopefully, after watching this, with a deeper understanding of how we trade specifically, but how we're able to hold on to something like Crowdstrike for as long as we have and rationalize it, not just longing and then doing nothing, but literally managing the trade, intra-trade. We're going to talk through that. We're going to show you from step 1 through step 4, using the entire process that we utilize inside of TTI. So we're going to start with CoiFin. We're going to go through FinViz. I'm going to show you the exact scanner that we use to find the actual play. You can steal the scanner and use it for yourself. You can tweak it, whatever you want to do. We're going to talk through the actual charting portion on TradingView, why we charted it the way we did, how we found the entry stops, take profits, etc. Kind of go through some of the nuances that we look for inside of a trade. Go through Tasty Trade, which talks through how we actually selected the contracts. And then the most fun part is how do we actually manage expectations inside of the trade? Right? It's easy just to buy something and then forget about it for marketing reasons. But for those of us that actually trade, we have to manage the trade, and it's not always easy. It's actually the hardest part, right? Finding breakouts in strong areas of the market, not hard. But holding those things while mitigating risk is the hard part. So once you get over actually finding stocks that are breaking out, the next best thing is how do you actually stay with those stocks long enough to actually have an outlandish return? So we're going to talk through how we manage that in through an ER event, some of the expectations we had prior to ER, etc. And then we'll go through 3 different trade ideas briefly that you can go ahead and try to grab either tomorrow or sometime next week. We are starting to accumulate the positions that I will be talking through. We do have volume on the chain today. So you guys can steal the trades, you can mock the trades, you can make fun of the trades, you can do whatever you want, but I'm going to show you. So we're going to start in about 2.5 minutes. If you have any questions, feel free. If I see them while I'm talking, I'll try to take a quick pause and answer them. Forgive me if I don't see them right away, though. Try to get the chat up on Twitter as well. I just don't know if I'm going to be able to multitask this well, if we're going to be able to see both YouTube and Twitter at the same time. So it should be fun. Starting about 1.5 minutes. Do we have any TTI members that are watching this right now, or did you guys take Thursday night off? I don't blame you. If you're in TTI, though, you should know this entire thing. In and out. You should be up here actually explaining it instead of me. One minute. We'll start. So any questions, feel free. If you're on YouTube, I can see the chat live. If you're on Twitter, it might take me a little bit because I can't look at both YouTube and Twitter at the same time here without screwing the stream up, all right? So if you're commenting on Twitter, I'll try to look at it intermittently. If you're on YouTube, if there's an opportunity for me to answer it immediately, I will. Let's go ahead and get started. So without further ado, welcome. Thank you for showing up on Thursday. I know you're either choosing this or you're getting ready for football. So I appreciate you giving me about 30 minutes of your time here. This is going to be one of the shorter webinars, but it's going to be jam-packed. I prepared well for it. Hopefully you guys learned something from it. So let's go ahead and start. First of all, this webinar is considered the perfect trade. This is when all of the stars align inside of the TTI trading system and we turn a good trade into a great trade. And by great trade, I'm talking, there's a potential for 1,000% return. We call those grand slams inside of TTI. Before anybody sits there and says it's luck, it's this, it's that, everything in trading, there's a little bit of luck to it. But what's not luck is preparing for something like this and then executing it when it actually shows up. That's not luck. How far something moves, if you want to argue that, I'm not going to argue that with you. There's a little bit of luck with this. So we're going to call this particular trade the perfect trade, and we're going to talk through exactly how we found it inside of TTI. But as always, we're going to start with one of my favorite quotes from Mr. Stan Weinstein. My studies have consistently shown that two equally bullish charts will perform far differently if one is from a bullish sector while the other breakout is from a bearish group. Why do I always show that in basically all my webinars? Because that's the entire crux of TTI. We don't focus on the specific stock as much as we focus on the sector and industry and then plug the stock that fits that specific idea. That is more important than the individual stock. Okay, so let's actually go into, if you were on the email list or if you were watching the live webinar when we ran this it was the monthly charting session. This is the literal slide show that we had put together on November 1st. And we were talking about the idea back then, and this is relevant because we were opening this position back then, right? So I need to put us in that frame of mind. What were we thinking at the beginning of November, end of October? First of all, if you were trading at the end of October, you know that it was a very precarious time in the market. We were either going to fall to new lows or we were going to bounce hard. And most people were thinking, hey, we're going to fall to new lows. And TTI was no different. We were definitely short biased, but we had only taken 3 or 4 shorts through the entire corrective phase from end of July through the October lows, right? We only took 3 or 4. We weren't very aggressive. We were actually more bullish than we were bearish, but we didn't want to open longs until the market found some sort of floor or pivot. So this is from that November 1st monthly charting session we had inside of our group. And I want to start this off with, we asked the question, I think we ran this on a Wednesday, did the market bottom last Friday? Great chart from Riot Dietrich. It ended up being the right chart. The market did bottom on October 27th. So we were asking ourselves consistently, what is going to turn us bullish here? When should we start opening the floodgates and start buying longs instead of shorting pops? Because if you think about it, at the beginning of November, this was still the tail end of the corrective phase. People were shorting the pops, right? It makes total sense. And so what we were doing is we were trying to build this bullish thesis. Well, what do we need to actually start getting bullish? And we looked, you can see some of the things that we were looking at. Here's SPY on the weekly back then, not the greatest looking chart, but there was some underlying strength. Here's SPY on the daily. There's that divergence that if you watch that monthly charting session over a month ago at this point, that ended up playing out very well. There was a loss of momentum into the lows. That's generally a bullish sign. You can see U.S. sector performance. Tech was the leading area back then, sector-wise, from the lows of October of 2022 through the end of October of this year. So we knew once we started getting long, we wanted tech names. That was the area of the market that we wanted it to go long. We talked about the Magnificent Seven and kind of the role of large and mega cap growth stocks and what they meant to the market as a whole. We talked about industry performance, and what I want to focus here on really quick is what are the leading industries going back to the October 13th low in 2022, semis, home builders, and software. So we knew that, hey, if tech is leading and semis and software are up there leading the most, going back to the end of the bear market, the bottom, not the end, but the bottom of the bear market in 2022, that's probably where we want to be opening up the positions now, right? So we're building this bullish thesis at the beginning of November, and we're looking through semiconductors. And as you can see, this was the chart we were looking at. And we go, hey, this is a massive potential rounded bottom with a bull flag. And obviously, if you look at SMH now, we broke out into all-time highs. So that was the right call. Good job. We didn't position ourselves very strongly in semiconductors, but we were expecting this to break out, and it ended up doing it. And we were looking at, is NVIDIA going to fall here? Well, if semiconductors are going to break out, is it more reasonable that NVIDIA is going to bounce? This was an expensive play. We didn't take it. So instead we looked at, and here's your home builders, instead we looked at software, right? Software gave us a better opportunity to get long off of this floor without paying juiced up contracts, because NVIDIA is a super expensive name, right? And at the time, like I said, we were coming out of a 3-month corrective phase and we were starting to dip our toes long. And I think that's the most important part. It's never easy to do so, but when you start to build this thesis out and there's a lot of information coming in, it's at the very minimum, you're sitting there scratching your head and you go, this normally doesn't happen in a corrective phase. We normally don't see tech and things start to find a floor and start to maybe bounce a little bit. Some of the higher beta growth areas of the market tend to continue to come down the most in bear markets. Go look at consumer staples versus tech, or healthcare versus consumer discretionary. The growthy higher beta areas are going to get hit harder, but they stopped going down. About the 3rd or 4th week of October, and then October 27th low came in, and we started to see the pivot within tech, semis, software, etc. And so we scanned, and what did we find? We found Crowdstrike. And it's incredibly important. This was the chart we were looking at when we originally were opening up Crowdstrike. So we had already had a trade idea on this, which I'm going to show you as soon as I'm done with this little portion here. I'll show you exactly how we wrote it up the first time we were looking at this. But it's a very simple a resistance now turned support flip. We had opened it off the original breakout, which I'll show you in a second. The contracts that we originally opened were free at that point. We got up and over 100% before the pullback. And at that point, the TTI method really starts to shine. When our contracts hit more than 100%, you are told to close half of your position immediately, 100 or more percent. Why? You are completely removing all account capital risk out of that position, and you are now playing with house money. At this point, it's easier to manage the expectations of the trade. You can let it go a little bit longer. You're not freaking out every time we get a pullback because you're playing with house money. And I'm going to tell you something. You buy strong stocks in strong areas of the market over time, more often than not, you're going to hit some big winners. And so if we're playing with house money, why do we not let this thing try to bounce off of the previous breakout spot? This is a BRB, right? This happens all the time in trading. As a matter of fact, it just happened today in the communications sector. Go pull that up, XLC. We had a previous resistance turned support as a breakout, coming down, retesting it, and bouncing. This is TA 101. Everybody, doesn't matter if you're a mean reversion trader, you're swing trading, day trading, scalping, you're buying breakouts, doesn't matter. Everybody understands the basic concept of these level flips, and that's what we were observing on Crowdstrike. So if we actually go to circle here, you can see this was the original trade idea that we had at the breakout, right? So we were looking at this. We were on top of it. You can see it's the same chart I'm about to show you on TradingView. We had a play figured out here at the original 175 breakout. You can see we were buying some January call debit spreads at the time because it's an expensive play, but this was more than a 4-to-1 setup. And you can see that the risk on level was above 170, risk off below 160. Our profit targets are 200 and 218. Everything that you see on the actual trade setup here on Circle is how we traded this name. But what happens when all of a sudden we get this pullback? Well, you have a decision to make as a trader, right? Do you add in here? Do you take the original trade again? Do you go out a little bit further? Is this a supportive area to be buying? We made the decision, yeah, it is. We should be looking to average more into this. We have a free trade on the books already. Let's grab further out. Let's grab straight calls if we can, because at this point, the first position is house money. So we're not actively averaging into a new trade or into the old trade. We're taking a new trade. Let's take it. Let's see if this works using the exact same risk levels. And it ended up obviously working, right? So I want to go through Koyfin here with you guys really quick. And I want to show you exactly how to do that first portion. I want to show you how to actually go through quickly and figure out which areas of the market are actually showing the greatest opportunities. Because right now things are starting to shift around as well. We're going to do the same thing that we did with the Crowdstrike trade here. We're going to come out to the year-to-date chart, and we're going to look at which areas of the market are performing the best. You have your tech, your communication, and your consumer discretionary, which shouldn't be a surprise. We're in a bull market, and the higher beta growthy areas of the market are outperforming. Why would you not want to own those, right? That makes total sense. Coming into the 3-month here, going all the way back to the beginning of September, what's the number one performing sector? It's tech. Once again, this shouldn't be a surprise, but there is a hat in the ringer now for financials. So this is a new sector that's starting to potentially outperform. We're starting to see this a lot on the 50-day high scans. Hint, hint, if you're looking at new positions, financials are starting to make a little bit of a splash here. Communications, as you can see, and consumer discretionary lagging a little bit over the last 3 months underneath SPY, but you can see the uptrends here, right? And that's the most important part. You want to be looking for uptrends in sectors, try to go for the sector leaders, tech, financials, communications, etc. So if you know that tech right now is leading, hint, hint, over the last 3 months, maybe you should be looking at opening up new tech positions. Let's go to the industries tab. So within sectors, you can niche out industries. So for every sector, there's a certain number of industry groups inside. So if we know that tech is leading, there are three main, at least in Koifin, three main industry groups that are going to stand out in tech, right? And it's going to be your semiconductors, your software, and your internet. So if we know that tech is outperforming, is it reasonable to expect that those three industries are going to be outperforming? Yeah, but they don't all outperform at the same rate, if you will. Semis are blowing everything out of the water at 58.77% on the year. Software slightly behind at 52.62, and internet way behind at 41.62. So understanding that sectors and industries, this is one of the greatest edges you can have in a top-down approach style of trading. I asked you, would you rather own a semiconductor name here or an internet name? Look at the difference. There's like a 15, 16, 17% difference year-to-date performance. You should be looking at semis over internet. I'm not saying that all of the semi names are going to outperform internet, but as an industry group, semis are the best. So we should be looking at that. But let's bring it down to the 3-month, and it becomes a lot more muddled up. Semis are actually only up 4% over the last 3 months because we're having a lot of sector rotation right now. And the industry group that's leading is regional banks. We were just looking at the sector performance on year to date, and the 3-month and financials are starting to put a little bit of an exclamation point on there. You should probably be looking at. Now we have regional banks up the most over the last 3 months. Hint, hint. Once again, go scan for those. But software hanging out at 7.7 or 7.27 over the last 3 months. So you can see that we still have that software group that's leading. So if tech's leading over the last 3 months and year to date, software is leading or top 3 year to date and on the 3-month, you should probably be continuing to open or at the very minimum hold your software stocks. But here's where things get really interesting. So it's not hard, per se, to say go out and buy tech software stocks or go out and buy tech internet stocks or whatever. That's not the hard part. That's super easy, actually. What's hard is understanding the nuances between those in particular things. What is the difference between a mega cap, mega cap tech semiconductor and a small cap tech semiconductor name? Do those move independently? Yeah, they do. Market caps have edge. Right? There's something called the January effect going on right now. If you haven't checked the market, IWM is outperforming all of the other major indexes over the last month. It's up huge. It's not on accident. And you can see that right here on Koifin. Over the last month, you can see these huge uptrends starting to form in an area of the market that has been absolutely crushed all year. This is your small cap growth space. Look at the nice rebound off of about the first week of November through the second, or I guess the beginning of the second week of December. That's a huge move. From 4 to 10, and this is relative performance against SPY. So it's outperforming the market right now, while mega cap growth, which has led, large cap growth, which has led all year, is starting to draw down. That's not to say you should be going and selling your large cap growth stocks, but it is to say that maybe if you're looking at opening new things, there are better opportunities in the market than buying Apple and Microsoft here. If you're already in them, great. But if you're not, maybe you should be looking at some small cap growth. Or maybe some mid-cap growth, hint, hint. Let's go down to the 3-month here, and look what we got. First off, we have large cap value out of nowhere. Absolutely nowhere, this thing is starting to lead. No idea why, or do we? We just saw financials. Are financials a large cap value space? Yes, absolutely they are. Let me ask you again. Small cap value. What do you think the largest industry group within small cap value is? Could it potentially be regional banks? Yeah, it absolutely could. And same with mid-cap value, right? So this all builds on top of each other. Back at the beginning of November, we had built out this entire process to go and grab large cap, because at the time, large cap growth was outperforming everything off of the bounce. We can see here, let's see, where's large cap growth? Going back to, we'll use the year-to-date chart. If we go back to the November space, nothing was necessarily in an uptrend yet, right? So we were like, let's default to what's been working all year, the large cap tech space. We knew we wanted large cap tech. We knew we wanted software. It all comes from this multi-layered Koifin attack. All right. And I just showed you a couple areas of the market that are starting to outperform: smalls and mid caps, financials, software. We're going to go through that at the very end of this. So let's actually talk through really quick how to find, if you're using, I don't get paid by Koifin to tell you guys to use this, but this is absolutely the best program you could use as a trader. I'm just going to tell you right now. At least if you're a trader that has more than 5 IQ points and buys things that aren't just triangles on the fucking chart. Go through Crowdstrike. You can go through all of it if you want, but we can actually find where within ETFs it's held the most. And one of my favorite things to do is kind of get a general idea of what type of themes and what type of sectors and industry groups really own a lot of this. And we can double check really quick that IGV right here is one of the leading sector ETFs that owns a lot of these shares. 735, 2.4% of the actual ETF is there. Cyber, this is a cybersecurity name, right? So cyber here, 4.25, 986. So if you're going for a theme play like cybersecurity, you can go and deep dive cyber and find CrowdStrike, or you can use CrowdStrike to reverse engineer it. We did that with IGV, right? So we went through and we go, is this a software related name? It says it, but how much within the actual software ETF is it held? And we know 2.4% is not a small amount, right? So CrowdStrike matters to the software ETF itself. And I also want to point out, if we pull up IGV, which is the actual ETF itself, and we go to holdings, CrowdStrike at the time was the yearly leader. This is how we build the macro thesis before we plug the stock in, okay? So we built out the full thesis on what we wanted, and then we plugged it in. We saw, hey, maybe Crowd's a decent idea because it's already up at that point 100+% year to date. If you look at the other area, other sector leader, which is PanW, it's up 110. PanW's at all-time highs right now. We're in that one as well. That trades up 400% right now, or 300%, something like that. So we went long this particular industry group, software and cybersecurity, but CrowdStrike was the better trade, and we knew that. Why? Because it was leading year to date. All of this stuff matters. So how do we actually go and find this stuff? And this is where most people get lost. All right, most people get lost here. You can steal this scanner if you want. I don't care. This is not proprietary in the least. As a matter of fact, I want you guys to steal it and tweak it. Do whatever you want with it. But I'm going to talk through this really quick because this is the exact scan that we used to find CrowdStrike at the time. Everything that we do is predicated on strength in bull markets and weakness in bear markets. We don't want to buy the weakest stock because statistically that stock is going to underperform. We don't want to short the strongest stock because statistically that stock is going to underperform. We want to short the weakest and buy the strongest. So what is a better way to find breakouts and strong stocks than 50-day highs? What's consistently hitting 50-day highs? You can use a 52-week high as well, but we always start with the 50-day high because generally, especially off the bottom, it's going to take a long time to see some 52-week highs show up. After a 3-month corrective phase where the indexes came down 10%, we're looking for 50-day highs, not necessarily 52-week highs. So we rolled with that. We want to look at over 1 million volume for on average. We want to filter out all of the non-liquid shit. This also helps us get away from areas of the market, or specifically chains that don't have any volume. We're swing traders. We're going out 60, 90, 120 days. If you're not aware, options volume might be up, but most of it is front-loaded onto weeklies or 0 DTEs. So swing trading, we really have to go and dive through a lot of the options chains. It's not as easy as just, I want to go buy a July. You have to verify open interest and volume. So having average volume over 1 million at least filters out a lot of the stuff that's going to have nothing. Relative volume, right? We want names that are trading on higher than one normal average volume. The market wants this name right now into a 50-day high. Does that or does that not indicate maybe some potential relative strength? Yeah, we think so. We want to make sure it's optionable and shortable, and we also want to make sure we're not buying it off of a low. Sometimes we'll see 50-day highs where the RSI is still below the 50. This is very unique to TTI. We only go long if the RSI is above 50. We only short if the RSI is below 50. We use this as a trend indicator, not a mean reversion indicator. So above 50 is more bullish than bearish. Below 50, more bearish than bullish. Excuse me. And so if we're looking to go long, we want this to be above 50. So if we actually look through the charts really quick, well, first thing I do actually is take out ETFs. So you can see it trims a few off. I filter through sector to see what type of stocks are hitting 50-day highs today. If there's any themes here, looks pretty even. There's a lot of financials. Hint, hint. Keep saying that. Decent amount of tech as well. So what we're going to do is we're going to go through first page, and I'm not planning any trades off of this. I just strictly want to show you the process that we use to scan. 50-day highs, you can see it's very basic, and we're looking for horizontal level breaks. That's it. So we scroll through really quick, and if you know what you're looking for, this won't take you more than 5 to 10 seconds per page, so there's nothing there. Keep scrolling, keep scrolling, keep scrolling. We know exactly what we want to try to trade. There's nothing there. By the way, just so everyone's fully aware, we are very long already. PRU, that looks like a potential horizontal level breakout. It looks like it's an insurance name, though, so we probably won't trade it. SNV, here's a regional bank, horizontal level break. This looks like an island reversal fractal. TFC is a name that two of our guys in the group actually entered in a few days ago. This is an island reversal fractal with a horizontal level. And the regional banks, right? I'm telling you, we're long regional banks. I'm talking my book here a little bit, but it's on purpose. I just proved to you that maybe there's something going on there that most people aren't aware of yet. ARDX, a potential horizontal level break with a pullback. What we do is we build this list out on FinViz, and then we go to TradingView, and we pull them all up individually. So we generally take a list of we start with 500 names. We whittle it down to 20. And then from that 20 on TradingView, we whittle it down really quick to 8, because some of them are going to look great here, but not translate over to TradingView very well. And then from there, we actually plan the trades. So you can kind of see the thought process. There's a horizontal level break on Porch. We had a guy call that out a couple days ago. AMD, we have a couple guys in AMD. Anyway, you see the thought process there. This is the exact area that we were looking at when we found Crowdstrike. Why? Well, because Crowdstrike was breaking up into a 50-day high on higher volume. This is the exact thing. You can find some great stocks utilizing this specific scanner. So steal it. And if there's not a lot, go to 0 to 5% below the high. And instead of names that are already breaking out, you're going to be looking for names that are pressing up into overhead resistance, Goog maybe. And then you can plan to buy the breakout or the pullback. So there's a little hint for you on FinViz. Simple walkthrough on the 50-day highs. Let's pull up TradingView. Let's actually talk through the setup here. So you can see it now. Let's go back really quick. And I want to focus on that mid-monthly or the monthly charting session. So I want you to look at what Crowdstrike was doing when we re-entered the play. This is where it was. We'd already broken out and we had pulled back. This is our BRB setup, right? Breakout, retest, bounce. I'm not going to go through it, but this is essentially how we get long about 85% of our trades. We buy the pullbacks in strong breakouts, normally because, if we go back to TradingView, if you think about it, most people would have bought Crowdstrike, watch it come up, come back down, and stop out because they're like, well, shit, I bought the top, or this is a failed breakout. We look at this as an opportunity to average in, or in this case, open up a new position because we had already had free contracts on this, and we did, right? So we were saying, essentially, we're buying the pullback in towards the 170 area. If we fall below it, we want out. It's a very high risk-to-reward setup, because we're saying essentially if we close below this specific support level, we don't want it anymore. We get to hold the exact same PT level. This is a 10, 11 to 1. So it's the same trade idea, but it's a completely different setup because instead of buying the breakout, we're buying the pullback, and that changes the entire trade's risk to reward because we can utilize a tighter stop because we're assuming that it's going to bounce at support. If it doesn't, we're out. We lose very little, but the potential bounce on the same price target as the guys that originally bought the 170 pivot, you can kind of see where I'm going with this. It skews it more in your favor. That's why we do this all the time. And if you're trading options, you can generally get options contracts that are 50, 60, 70% off. The same trade, same price target, different stops, cheaper contracts. Obviously skews risk to reward in your favor, right? Okay, so we bought the pullback here, and what we were expecting originally was this 1.618 fib extension as our price target. I think the original price, let's go back to circle here. The original price target was 200 first, nice big round number, and then 218. Yeah, so that was the original price target that we had, and all of this is based off of fib extensions. So let's actually talk about that. Let's talk about building horizontal levels on something like this, and then how do you place a Fibonacci extension. Most people fuck this up. It's super simple. They overcomplicate this shit. All you have to do is find some sort of range. That one trick, I guess I will say, is that the size of the range matters. And what I see a lot of traders do is we'll just do something like this really quick on like a 1 minute, and then they'll draw some rinky-dink fib extensions like this, and that's not doing anything. Like, you're going to take a trade and you're looking for like a 0.5% move. You have to have a decent sized range here to be able to throw some fibs on it. Otherwise, you're going to be too compressed and the trade isn't even worth taking. For example, if you're taking a trade to capture 1% as a swing trader and your stop's at 0.3 to the downside, so you're still skewing that like almost to a 3-to-1 setup, it's not worth your fucking time taking a trade to capture 1% as a swing trader. You want some meat on that trade. So really quick, just to prove a point, shift click up. We're looking for a almost 30% move. That's a fucking swing trade. And so that's why we're here. That's why we're interested. So we look for a horizontal level on a range like this. Does it make life easier or harder just to simply split the range down the middle? I think it makes it a lot easier. We do it all the time. We have the full range here. Above the middle of the range is more bullish than bearish. Below the middle of the range is more bearish than bullish. What price is right in the middle of the range? You want to focus on those big, nice round numbers. Ask me why that matters. Well, the CMT material for a chartered market technician says we don't know, but it does. Price tends to gravitate towards nice big round numbers, which is also why our first price target was $200. It's not based off of anything other than self-fulfilling prophecy. Seriously. Whether algorithms are driven to it, retail traders are driven to it, it doesn't matter, but it's a known phenomenon. So we said 170, it could have been 156 or 167. It could have been 174. We chose 170, nice big round number. And then what we do, and I'll draw it again here, your one level is always going to be at that entry. So in our case, we chose the 170 area. Like I said, we can mess with that to make it perfect because I'm OCD about it later. You want to but you want to click to the left and then drag to the right to the bottom of the range. That's it. Bottom of the range. On any range you're looking for. Remember, we cut this in half. So this is the range we're working with. We cut this in half. This is the range we're working with. You drag down and to the right to the bottom of the range, and what you're going to get is these nice little numbers that are imaginative. It's all based off of math, but I don't want you to look at this stuff. Bukowski's come out with a lot of information that's basically said, if you're looking for pullbacks, golden pocket, stuff like that, he says that it's all fucking fugazi. That there's no statistical evidence that golden pocket and pullbacks at certain fib levels actually matter. If it does, it's coincidence. You do it a couple times, you're going to think it matters, and you're going to continue to do it. I have no skin in the game in that. Just saying, the Lord and Savior Bukowski, who has quantified more strategies than anybody I know and is the most quoted technician in the CMT material, says it's bullshit. The reason why fib extensions work is simply as a risk proctor. If you enter at the 1 and draw down towards the 786 and your profit target is at that 1.618, you almost get a 3-to-1 setup every single time. So from a shares perspective, it's fantastic. As a swing trader, you don't want to trade anything under 3-to-1. It doesn't make any sense. For every dollar you risk, you want to make at least 3. And if you can tighten the stop based off of technical analysis, which we did, you can skew it heavier in your favor. It's a 4-to-1, whatever. Okay, so that's how we built this. And because I'm OCD, I'm going to go ahead and put it back at 170. And I don't know what this was, 92 probably on the dot, something like that. We'll run something like that. So that's how we found the horizontal level. That's how we drew the extension. A few other things that I want you to see here is that the 200-day moving average, if you have it on your chart, use it. And I don't mean use it as dynamic support. It's a 200-day moving average. If you're Stan Weinstein and you want to buy pullbacks, totally fine. But I'm not fucking Stan Weinstein. I'm not using a 30-week moving average to time entries. What I am looking for, though, is prices above it. Are we above or below the 200-day moving average? That matters. Institutions, not necessarily taking trading ideas off of this, but Paul Tudor Jones very famously said, I'm not buying shit below the 200-day moving average. Only bad stuff happens below it. Paul Tudor Jones is a pretty goddamn good trader. I take that to heart. I don't buy things below a 200-day moving average. I don't sell things above a 200-day moving average. So we wait for stocks that are trading above the 200-day moving average. And let's add one extra variable in there that most people don't even think about. Think about the slope of the 200-day moving average and how long it takes something like a 200-day moving average to change. If we're saying Crowdstrike is in an uptrend, series of higher highs, which it very clearly is, but maybe it's hard to buy because the market is coming out of a bear market, maybe the corrective, whatever, it doesn't matter. It's hard to buy this thing. How can we give ourselves a little bit more conviction? The 200-day moving average all of a sudden is below price, which means, hey, we're trading above it, and it's starting to slope upwards. When it originally broke out, this was one of the few stocks that were in the large cap software space that were giving us a good entry with an upward sloping 200-day moving average. How long does something have to trade above its 200-day moving average to start to influence the slope? Quite a long time. And if you look at the original breakout, we had been sloped up for almost 2 months. That is a long time to start sloping up. Do you have any idea how long it would take for CrowdStrike to roll back over and start sloping down? A lot. This is one of those things you can add to your checklist. If you see the slope of the 200-day moving average, this is a slow moving average on purpose. It validates the trend. Now remember, it's slow moving, which means price is going to break down before the 200 starts to react. So just keep this in mind. It's not like a wonder tool, but it's a great way to give yourself a little checklist. Hey, how valid is this trend? Are we trading above it? Is it starting to slope up? Yes. Okay. That's double whammy there. We like the trade, right? Let's look at the RSI really quick. We utilize something called a bullish momentum and bearish momentum regime inside of TTI. If you remember the scanner I talked about, we only buy stuff above the 50-day, above the 50 RSI. We only short things below the 50 RSI. Draw an imaginary line at the 50, right? If the RSI breaks above it and is majority range bound below the 100 and above the 50, Buyers are in control of the trend. Conversely, cut it in half. If the RSI is range bound for the most part, below the 50 and above the 0, bears are in control. This is statistically proven. You don't have to use the RSI as an overbought and oversold indicator. As a matter of fact, I hate it. I would rather prefer to stack more ducks in line with the trend than anything else. I don't give a shit if something is overbought. Things can stay overbought for weeks or months, and I want to be long before that happens. So if we learn how to use the RSI to once again validate the strength of trend, it can give us a little bit more conviction to buy when the brain is telling us, be careful. The scary guy on FinTwit said a recession's coming. Do we really want to dump a bunch of money into a cybersecurity name right now? I don't know. The market is telling us based off the RSI that all fucking year, the market has wanted to own CrowdStrike. All year. Very rarely has it traded below the 50. And at the time, it had been up about 100% year to date as a leader within the industry. So there's another tool you can use, 200-day moving average, sloped up, price above it. Where is the RSI? How long has it been range bound above or below the 50? And then once again, you don't want to get stuck in names that don't move. And that's a big thing. We have a 3-month trial. We have about 12 to 15 new traders in TTI. This is their second week, and they're starting to get their bearings about, how are we trading? What types of trades are we looking at from a technical standpoint? And a lot of them are putting out some great stuff. Here's a chart, for example, Costco. All right, Costco is breaking out to an all-time high. If you zoom out, this is a fucking trade everybody should be at the very minimum contemplating. Look at this. What the fuck? This is fantastic. Costco is about to break out into an all-time high, ascending triangle, consolidated for over 2 years. This is great. What's the problem on this? This thing moves like a slug. You're essentially going to be watching paint dry, which is no problem if your expectation is set accordingly. If you're a shares trader, you might want to go a little heavier in this. If you're an options trader, you might want to buy a little bit more time because this thing moves on average 1.33% per day from top to bottom. And you're looking for, off of this ascending triangle breakout, a 20% move. This thing's going to take probably 4 to 6 months to get up there. That's a great trade. I'm not going to lie. It's a huge, large cap, retail/consumer staple related name. But the ADR is telling us this might not be the most fun, exciting, or efficient trading vehicle. And that's the key word, efficient trading vehicle. Most of us are not long-term investing these positions. If you are, it's probably because you fucked a trade up and you don't want to sell it for a loss. That's bad juju. So what we do inside of TTI is we try to focus on names only above 3. Generally, it's a nice blend of volatility. Things actually start moving. You can buy 60, 90 to 120 days out and reasonably expect your price targets to get hit. That's why you're seeing the 500+% winners right now, because we have that nice blend of expiration, everything else, etc. Okay, let's go into Tasty Trade really quick. And I just want to talk through just the basic nuances of the way we select contracts. Let's actually just go to CrowdStrike really quick. So the contract that you're seeing right now, as a matter of fact, there's the contract right now. It's up 616.5% near the end of market, but I want you to focus. It's the $200 calls for January. Okay, so that was the original play that our member Brian opened up. He's the one that is allowing us to use his example right now for the entirety of this webinar. So Brian, if you're watching this later, thank you. If we pull up the Januaries, you're not going to be able to take this trade now, but it's still within our window, right? We don't open up anything. Well, it's right there. We don't open up anything with less than 45 days till expiration. When you go to a chain, the first thing you're going to want to notice is your IV. Where is IV? Is IV above 50 or below 50? If it's above 50, you can start to assume this is probably going to be either a call debit spread if you're going long, or you're going to be selling puts to get long. You're going to play the theta side of it. Why? Because above 50, and you're going to start messing around with IV crush. And that's what you don't want to get with. You don't want to mess with IV crush. You'd prefer to buy straight calls in a low IV environment because obviously calls are going to appreciate both with the directional move and with IV expansion. Start getting up and over 50 and it can start to get a little wonky. But we can double check that within Tasty Trade. We can use IV rank. So that's the number 2 thing I look at. So right now it's, we'll say 33 to 40. IV rank is 3.2. This is the average over the last 52 weeks where we're at right here in terms of IV. Right now, IV is in between 30 and 40. This is historically low over the last year. This is something that is unique to Tasty Trade, but you can add this to most platforms. There's scripts available, Thinkorswim, etc. Love Tasty Trade. Switch to it if you're an options trader. It's the best brokerage ever. I also don't get paid to say that. But anyway, that's the first thing we do. Where's IVs? So we get the general idea. We're buying calls, call debit spreads. We sell in premium to get long, etc. Then we want to look at the expirations. So right now within our group, we're looking at May's, April's, and March's, but not all of the options contracts are going to have all of those available, right? They're not going to. So let's just go with March's because this is our window. Right now we're going for the Marches for a lot of the trades that we're opening up right now. So let's go ahead and open this. So once we're in, we've already validated IV rank, and expiration. We know we have 99 days out. The next thing we could do is take a look at the price of the fucking contracts. This is probably the most important part for newer traders because there's going to be trades that you're just not going to be able to take because it's going to be too much of your account size. And that sucks. I'm sorry, but you got to play within the rules. Otherwise, you run the risk of ruin, which you don't want to do. You can blow an account very easily, right? Don't do that. So let's pretend, just for an example here, that you can trade these, that this is not too expensive. We make the decision internally. This is okay. I can afford this. Generally, we buy in twos. So 2, 4, 6, 8, 10, 12, whatever. Reason why? We want to sell half at 100%. Just easier to manage risk that way, but it's not essential. We want to look for the delta. 0.25 delta. Now, people love to ask me, why do we like to look for the 0.25 delta? And I'm going to tell you, because Tasty Trade has been offering options trading for the last decade, and they've quantified all of this data that says as a swing trader focusing 60 to 90 days out, that 0.25 delta is the best in terms of risk to reward. They have the data. And when I look at somebody that has been doing something longer than me, that freely expresses the data, and I can verify that it's legit, I just say, yep, you fucking know more than me. We're going to adopt this. And so we did over 2 years ago. We started targeting the 0.25 delta, and it has worked marvelously. It's great. It's a nice mix of realistic price targets, price, and not too far out of the money where we're going to get absolutely screwed if, things don't end up moving the way that we want. It's just a good starting place for anything that we're looking for. So what we would do here if we wanted to get long, right? Like I said, we validated IV rank, days till expiration, the price, the 0.25 delta. The last part is open interest in volume. And this is where it gets really tricky as a swing trader, and also something that you can use to look at some fake traders. Cough, cough. Not that anybody ever fake trades. You need volume and open interest on these goddamn chains to play ball. Otherwise, you run the risk of two things. Wide spreads, and you get screwed. If you've ever opened a position and you're immediately down 25%, it's because you got filled at the worst fucking price, and your price is going to show mid, but you got filled at the ask. You're going to be obviously down right away. So you're going to need the spread to be relatively tight to really want to get long this type of stuff. There's ways to get long with looser spreads. I'm not going to get into it right now, but that's generally the right way to think. You need volume and open interest for spreads. Also, or for the spread, not spreads in particular. Also, if there is no demand on the contract, which has happened to us before, we've traded lower beta things like MetLife, an insurance name, into all-time highs. What happens when you want to close it and nobody fucking buys it from you? What do? It's a problem. You're going to let it just expire? What happens if you're trying to close it for 100% win? You still have 3 months on the contract, and then all of a sudden it dips back down, and now you're down 60%, and you still can't fucking sell it. It's a problem. You need somebody to buy it off of you. So if there's nobody interested in the contract, no one's going to fucking buy it off you. So we have to validate that there is some sort of interest. Now, 3 years ago, swing trading, volume everywhere. Before zero DTEs really started kicking in, you could buy any contract on any expiration relatively easily. Now, like I'm showing you, we have like 100 open contracts on these plays. That's not a lot. So we have to think about this type of stuff. Does the spread make sense? Does open interest make sense? Is anybody actively trading this today? So now we've skewed our original filter set from 1,000 open interest and 100 volume on the day to a couple hundred open interest and anywhere between 10 and 50 volume on the day. And sometimes that volume is us, which I'm going to show you in a sec. We've had to skew back our open interest and volume requirements because there's not enough people playing ball out here on these contracts. Now, I will tell you that the closer we get to expiration, the more demand picks up. If we go to the Januaries, there's going to be a lot. One, because it was a leap. Obviously, these have been open for a very long time. But also, they're closer to expiration. If we go to the December 15th, you're going to see relatively a lot as well, which you can add a couple thousand open interest on a few of these. The farther you go out, the less open interest there's going to be. But if you're in this position for 3 months, we're coming up and getting in between that 45 DTE window, you're going to see people starting to buy those contracts and demand will creep in. It's not as easy as just saying buy this contract and wait. There's a process behind it. Trading is fucking hard, right? So that's why we try to teach everybody inside of TTI how to do this themselves. And obviously we do it as a group as well to train these trades. So as of right now, the last thing I want to talk about really quick with Crowdstrike, and we're going to go through 3 trade ideas before we wrap this up, is that the hardest part about this trade was not necessarily opening it. You guys heard, and if you are joining us late, watch the first 20 minutes of this. I got through the full process on Koifin of how we narrowed down the sector, industry, and market cap group to find Crowdstrike. That was not the hard part. That's a repeatable process you can do by yourself in 15 minutes on a Sunday. We do it every Sunday as a group for an hour. What is the hardest part about this is once you're in, and you're in a big win, right? We're up 100% plus. Most people would just close and be, I'm happy with 100%. That's bullshit. That's not how you trade. You don't close because you're green. Profit is not profit. That's not how this shit works. It's like essentially getting dealt double aces and limping in the entirety of the fucking hand and winning at the end, and the pot's 1/4 the size of what it should be. When you have the advantage, you press the fucking advantage. You press it. So when you find yourself in a trade that starts to go outside of your expectations, 100%, we'll say right here, I don't know where it was 100% for Brian in particular, but it was free. And then we get up here towards ER. There was already a big win. It was like 280, 290%, if I'm not mistaken. He was in the money. We're going through ER, and we had a discussion within TTI because we had a couple guys in calls, and we actually had a couple guys in the original spreads. That's a good way to put this. Bring this up really quick. Mike, if you're listening to this later, Mike is one of our traders that have been with us for 4 years. He was in the original play, which was the 210, 220 call debit spread at the time. So he's in the 210, 220 call debit spread, and we were right before earnings, right? We had like $2, $3 that he could get max on the profitability for that spread. But what happened if Crowdstrike didn't gap up? How much could you potentially lose? So spreads obviously are going to cap your potential reward. But the flip side is that it's going to be a lot cheaper to get long, and you don't have to worry as much about IV crush. So there's trade-offs to spreads versus calls, right? Mike had bought the spreads. And so he said here right before earnings, he's closing because the upside is capped at a very small amount, but the downside is huge. He's up 280%, 270%. He said, I'm just going to fucking close. There's no reason to hold this. Yeah, I could eke out a little bit more profit, but if we don't gap up, I'm going to lose a lot of the open profitability that I had. So he closed it. Now, Brian, on the other hand, who we're using this as an example, who's still in this for 600+%, we said, listen, Brian, you're up already. He's already in a free trade. He's closed half, and he's taken profit out on the way up. How many contracts do you have left? He has 15% of the original position that he has left. It's completely free. He's already taken a bunch of profit out. This was a multiple 100% winner. He goes, I'm going to let it ride. And we had an internal conversation. As a matter of fact, on Twitter, I asked, what would you guys do? In different Discord groups, what would you guys do? Most people said, I would let it ride. But I want to ask you truthfully. You're staring at a contract worth 300%. It's enough money to pay your rent and your car bill. Would you hold through an ER event? It's a hard question. It is a very hard question because emotions start to come into play. For Brian, thankfully, he's a little bit older, a little bit wiser, a little bit more patient. He goes, this is the type of situation you trade for. This home run could turn into a grand slam if we gap up. One thing I want to point out here is if you look at AMD's earning report back at the end of October, this is part of the reason why we started to get bullish at the end of October, beginning of November. We didn't go through this during the monthly charting session right now, but we did if you watched it back then. AMD's earning report came out. After hours, we were down 5%. You guys remember that? Where were we at market open? Break even. Where were we at the next day at market close? We were up like 5% or something like that. 9.69, excuse me. It was a complete reversal. And we go, bear markets or corrective phases don't drop a stock after hours and fucking ramp it 10% the very next day. That's not corrective territory. This is a different market. This is a different beast that we're trading with right now. Crowdstrike was the same idea. Hey, are we in a market right now that dumps good stocks off of ER? No, we're not. That's not to say it couldn't happen, but it wasn't happening. So add all of the evidence together, free trade, already taken profits, 15% of his original position still on the books. ERs were not getting gapped down. He said, I'm going to fucking take it. This is why we trade. He's put himself in the perfect position to be able to make that decision. That's what is the difference between TTI and other types of trading groups is we have the luxury to make the decision on whether or not we hold or we don't. If this gap down, still a great trade. He's closing for 100%, maybe a little bit more on the rest of it. Fantastic trade. If he doesn't and it gaps up, you are now in a Grand Slam territory. And he is, right? So right now, we're getting closer to having to close than not. He has 43 days of expiration, and we close within a 20 DTE window no matter what. So he has 23 days left to hold CrowdStrike. He's up 616% right now. This could, I'm not saying it will, but it has the opportunity to be 1,000% winner for him. And it all came down to that one decision off of ER. But it wasn't just a dumbass decision, I'm going to hold it because ERs go up. It has nothing to do with that. It's the full thought process. That's what clearly defines what you're doing inside of TTI. You can rationalize every single fucking step. Okay? Indicators, RSI, VRVP, which is your volume range profile indicator. It shows you volume based off of price instead of volume based off of time. So this is going to give you the volume histogram on the bottom, volume based off of time. This is volume based off of price. And then we have a indicator that one of our members coded, which all of this is, you could find individual indicators. He just put this information up here so it's easier to read. Average daily range, average true range, and relative volume. That's the only 3 that I use out of the 6. That's it. You don't need anything else. And a 200-day moving average. Okay, so what I want to do here is, you've heard the entire spiel on the CrowdStrike trade, and he's still in it. Take what you just learned and implement it into your trades. Have a thought process. Have a process for every single thing you do. Some of them are not going to work, and that's okay. You can go back to the drawing board. If it wasn't your fault, sometimes it's just not your fault. Sometimes the market just fucks you. It happens. You can play it perfectly, and it just fucks you. It will happen, okay? So don't beat yourself up if you're in a great situation and it goes against you. Put yourself consistently in those great situations and watch how many of them do work for you, and watch how much it skews your skews your yearly P&L in your favor. Okay, so for the next 5 minutes, and we're going to wrap this up, 3 trade ideas that are hot right now that are the same kind of idea as CrowdStrike, which is why I want to talk through these. We opened up Sentinel-1 today, posted it on Twitter. If you're privy to the Wyckoff market model, Stan Weinstein stage analysis, what is this? Right, this is a potential stage 2 breakout. So here's your accumulation stage 1. We can verify that with the VRVP. There's a financial institution footprint accumulating down here at this 15.5 area. We love to see it. Price is above the 200-day moving average, starting to slope up. RSI is above 50, 3.93 ADR, which is exactly what I was just talking about with CrowdStrike, right? We gapped up and over 23, which is our horizontal level. This is a power earnings gap. We did not come up with that name. Everybody calls it this. So PEG, we like that. That's bullish. That means that there's a change in sentiment of the stock. Whatever came out in earnings, the market loves it. We gapped up and over 23. We decided to wait and not chase yesterday, and we got the pullback in towards the level. What were we talking about with CrowdStrike? We want to buy the pullback at the level. What are we talking about Sentinel-1? Draw the fun gray box, buy somewhere in the gray box. We got filled somewhere around 22.25 and 22.50 today, and we're looking for a $30 move, right? So I'll show you what the actual contracts look like that we grabbed. And you guys can mirror it if you want. I don't care. Steal it, criticize it, make fun of me. Don't give a shit. March 15th, $30 calls. We got filled at 65 to 70 cents. This is our footprint on the chain. So we got 180 of these contracts today within the group. That's what we're doing with Sentinel-1. We're expecting this to hit $30 by March. Actually, a lot sooner than that. It's the same idea. 50 IV, 2.4 IV rank, 0.25 delta. It's the same thing every single time, guys. Same thing every single time. That's why it works. We have a repeatable process. And if it doesn't work, we can generally figure out why. Next trade is GitLab. Posted this on Twitter as well. So if you're not following me on Twitter, at How to Swing Trade, I'll bring that up right at the very end so you can follow if you want. We do put out trade ideas like this. You don't have to pay me. You're taking the same trades as us, and sometimes you guys are getting better fills than me, which is ironic. I should be front running everybody like every other asshole on Twitter, but I don't. GitLab, once again, same sort of setup as Sentinel-1. Got the markdown period post-IPO, accumulation into a potential stage 2 right here with a power earnings gap, right? There's your power earnings gap. There's your earnings that came out. VRVP, let's go ahead and delete all of that because it looks like shit. VRVP is showing us 2 spots where there's some financial institution accumulation here, 32.5 and around $49 to $50 within this range. We like this, right? So we can see where financial institutions are really active here. Retail traders are not accumulating stuff with this type of volume. This is people with money, generally financial institutions. That's why we love this VRVP indicator, because we can see where at different price points, potentially there could be support, resistance, financial institutions buying, accumulating, etc. We love to see these big, long 2-year bases because generally the bigger the base, bigger the breakout. We want to own above 59 with a price target of anywhere between 75 and 80 bucks. A stop somewhere. We don't want to hold it to 52.5, but we don't want to own it below the original PEG low of day. So somewhere around 55.19. Right, so it's going to give us a tight stop with a nice profit target. We go out to the chain here. This is going to be a little harder to get long. I think a lot of people inside of TTI were grabbing shares as well as contracts, but that's probably us. There's some guys that refuse to trade shares, but that's probably our footprint right there. The $75 calls, 57.3 IV, 3.4 IV rank, 99 days, 0.25 delta. It's repeatable. All this fucking shit is repeatable over and over and over. That's our little footprint today because GitLab is actually not breaking out yet. We're right there. We're right on the cusp. So some of the guys inside of the group are taking the liberty to try to front run it a little bit, but this is a good setup as well, right? You got the power earnings gap. It's both of these, by the way, mid-cap software names. So if you remember, go back to the Koifin stuff we were just talking about. Where should you be looking? Some financial names, right? Some regional bank names, software names. But are we looking at large cap software right now? No. Remember, factor analysis showed us that smalls and mids are starting to outperform. Well, why aren't we looking at mid-cap software names? We are. GitLab. Why aren't we looking at mid-cap software names? We are, right? So it's amazing. We talk about it and then we do it. Last one I want to bring up really quick is Datadog. I like Datadog better. We have a trade on Snow that hasn't triggered yet. Snow looks a lot like Datadog, but Datadog looks better than Snow. So we're just going to talk through this. We like this above 11650. We did already start buying this and we have stalled out. So I don't know if this is going to be a winner or a loser in the grand scheme of things. But we do like this above 11650. This is a large cap software related name, but it has all the tangibles to be a winner. 200-day moving average is sloping up. Prices above it. RSI back up into overbought. Little bit hesitant about the bearish momentum regime through the corrective phase. Some of the stronger stocks didn't have that. So we're taking a chance here on Datadog. But something that Datadog has that the other examples didn't is the other examples were clearly in markup phases off of new IPOs. Datadog has been trading since 2019. So there's some potential overhead supply here where price had previously traded through back in 2021. So how can you as a trader come up with levels that reasonably make sense based off volume? Your VRVP. So not only is your VRVP going to give you this mountain shape that is indicative of accumulation, it's also going to tell you if there's a lot of people that had bought north of 11650 during the previous run-up. Is there going to be substantial overhead resistance that you need to worry about? Probably not. Not a whole lot. And so when we take these type of trades, if we see all of a sudden a big, we'll say mountain here at 115, kind of correlates here with this price target. Let's pretend it doesn't. We would potentially put our price target here, or if it's closer to the actual entry, let's say there's a mountain here, we wouldn't take the trade. There's no point, right? So we're using this volume to verify whether or not the odds, and it is odds, of overhead supply potentially stifling the breakout. So this setup, not as bullish as the other two, but we like it because it's a large cap leader within the space that it's in. It is coming up and hitting 11650 repeatedly. We'll see if it flips. We're already long, so Gracias de Deus, please. ADR 3.18. There we go. There's the full setup there. From a options standpoint, the Datadog trade. Go out to the marches. The first PT is that 150 area. 150 is 0.15 delta. One thing I could tell you guys, if you're swing trading options, is try not to buy on the outside of the standard deviation band. You guys know anything about simple statistics? What are the odds that outside of one standard deviation, something is going to work out? Not high, right? So these dashed lines on your options chains give you one standard deviation away from current price. If you can buy on the inside, it's generally advisable. What we do inside of TTI is when we're actually buying spreads, if their volume and open interest makes sense, we like to sell the outside standard deviation band and buy the inside standard deviation band. We call this our little golden pocket because obviously we want the 145 to expire worthless in a call debit spread, and statistically it should, right? So the Datadog price target is going to be 150, but we can get a little bit of a deal here on the 135s, 140s, capturing the 0.25 delta in the middle. Both of these have over 1,000 open interest, a little bit of a volume on the day. 0.3 IV, the 10.1 IV rank. This is a better calls play than not. So you could buy the straight 140s for $310, or I don't think you'd get away with being able to sell the 145s very easily, but we could call debit spread this. This is a 4-to-1 setup, cost you 97 bucks for a 403, get up to 140. You can roll this if you want to continue to play, but that'll get you in for less than $100 with a $400 price target, or excuse me, $400 max profit, and then 140, 145, not my favorite setup, but obviously a greater than 4-to-1 setup. So there's different ways you could play this inside of TTI. We've played it a few different ways as well. But guys, that's basically it. The only thing I'm going to show you before we leave is my Twitter, my tweetser. Follow me if you're not following me. The reason why is because I post this stuff already, all day. Right? We talk about stuff like Hood. Didn't talk about it today. Potential stage 2 breakout on Hood. Talk about what are the implications of ARK breaking out in terms of high beta risk stocks. You probably shouldn't be shorting and expecting new bear markets if ARK is about to break out. Things like that. Talk through and update previous trades that we have. A lot of good stuff. I try to give you guys as much info as I can, with all obviously also being fair to the guys that pay me, because hey, guess what? A lot of people do pay me for this stuff and it tends to work, right? So if you have any questions, please, I appreciate it. Feel free to leave them below the video. And that's it. I appreciate you guys taking the time to sit here on a Thursday night with me for an hour. Follow me on Twitter. I respond on there. You can respond on the video on Twitter as well, and I'll comment.